Bullsmart with Bullsmart. In our previous 8 lessons, we've covered the basics of mutual funds, including what they are, different types, how they work, and how to evaluate them. Hopefully, you've got a good introductory understanding of mutual funds now. But it's not as simple as just buying a mutual fund and then kicking back without a worry. Actually, there are some common misconceptions and traps in mutual fund investing that, if you are not careful, could affect your returns and satisfaction. So in this final lesson of our series, we are going to shine a light on these misunderstandings and traps and show you how to avoid them and improve your mutual fund investing skills. Mistake number 1. Chasing highs and lows, following the crowd. When you decide to buy a mutual fund, market influences might make you act irrationally, like chasing highs and lows or blindly following trends. You might think that just by following the market's hot topics and trends, you can make big profits. You might focus only on a fund's price and popularity, ignoring its true nature and value. But this approach is risky because markets are fickle. Today's hot topic could be tomorrow's old news, and today's gains could turn into tomorrow's losses. If you just chase highs and lows blindly, you might end up buying high and selling low, leading to a big loss. Plus, you might miss out on funds with real potential that aren't getting as much attention. Markets are complex and diverse. Everyone has their own investment philosophy and style, and each fund has its own strategy and portfolio. If you just follow the crowd, you might end up choosing funds that don't suit you or align with your investment goals. Plus, you lose your ability to think and judge independently because you're just following others' opinions and advices. So, how can you avoid these pitfalls? First, don't just look at the surface of the market but understand its essence. The market surface is influenced by many factors like supply and demand, policy changes, and emotional fluctuations. Sometimes these can lead to irrational or exaggerated reactions. Don't be fooled or tempted by these. Look at the essence of the market, which reflects the real state and trends of the economy and society. Have your own market viewpoints and judgments, and don't just go with the flow or follow the crowd blindly. Second, don't just look at the fund's price and popularity, but its value and potential. A fund's price and popularity only show how the market recognizes it at a specific moment, not its investment returns over a period. But a fund's value and potential can show whether it can achieve its investment goals and outperform its peers in the longer term. So, have your own methods and standards for evaluating funds, and don't just believe or blindly follow the media or others. Mistake number 2. Ignoring the cost of mutual funds when buying mutual funds. You might overlook the fee involved, thinking that they won't really affect your earnings much. You might believe that as long as the fund's return rate is high, the fee aren't important. You might ignore various costs like purchase fee, redemption fee, management fee, custodian fee, and also how the fund's dividends, portfolios, adjustments, and turnover can affect your costs. This approach isn't smart because the fee of a fund are directly or indirectly deducted from your earnings, reducing your actual returns. Generally, the higher the fund's fee, the lower your returns. For example, if you invest in 2 funds, one with an annual return of 11%, but with 3% management and 0.5% custodian fee, your actual return is only 7.5%. The other with a 9% return but only 1% management and 0.2% custodian fee will actually give you a 7.8% return. So, you shouldn't just look at the surface return rate but at the net growth rate, which is the return rate after deducting all fee. So, how can you avoid overlooking the costs of mutual funds? Choose funds with special offers or characteristics to reduce your costs. You can also opt for index funds or exchange-traded funds, the ETFs, which usually track a certain index or industry performance, thus reducing management, custodian, and portfolio adjustment fee. Mistake number 3. Lacking a long-term perspective and patience after buying mutual funds. You might not have a long-term perspective and patience, thinking that investment in funds is a quick way to get rich. You might constantly check the fund's net value, market trends, and media comments, being overly sensitive and critical about the fund's performance. You might frequently adjust your fund portfolio, trying to catch every opportunity or avoid every risk. But this approach isn't advisable because investing in funds is a long-term commitment and it takes time to see their true value. The market is volatile, unpredictable, and uncertain. Short-term ups and downs don't truly reflect a fund's level and potential. Only over the longer term can you see if a fund meets your expectations and goals. So, don't just focus on immediate benefits but look towards future development. Investing in funds require patience and confidence. You shouldn't change your investment plan on a whim. Frequently adjusting your portfolio not only adds costs and risks but also affects your judgment and understanding of funds and the market. You might miss good opportunities or fall into bad traps. So, don't stick to your investment philosophy and style. How can you develop a long-term perspective and patience? Follow these tips. Don't just look at the fund's net value, but at its performance report. The net value only shows the fund's market value at a specific point, not its earnings over a period. Performance reports provide more information like investment strategy, portfolio composition, industry analysis, market outlook, etc., helping you better understand the fund's operation and future prospects. Regularly review performance reports rather than focusing too much on the net value. Don't just follow the market trends, but understand the essence of the market. Market trends are influenced by many factors like supply and demand, policy changes, and emotional fluctuations. Sometimes these can lead to irrational or exaggerated reactions. Don't be fooled or tempted by these. Look at the essence of the market, which reflects the real state and trends of the economy and society. Have your own market viewpoints and judgments. Don't just believe the media comments, but consider this stance. Media comments might influence or guide your views on certain funds or the market. However, remember that the media is a neutral or objective. They may have their own stances or interests, might exaggerate or ignore certain information, and could have biases or misunderstandings. Think for yourself and don't blindly trust the media. Lastly, how to identify and avoid risks in mutual fund investments. There are indeed strategies and analytical techniques that can help you avoid many of the investment risks associated with mutual funds. By employing these methods, you can make more informed decisions and potentially enhance the safety and performance of your investments. Understanding the risk characteristics of different types of funds. Different types of funds have different investment objectives, strategies, portfolios, return rates, and volatilities, and therefore, they also have different risk characteristics. For example, equity or hybrid funds are usually affected by market risks, industry risks, and company risks, while bond or money market funds are usually subject to interest rate hikes, credit risks, and liquidity risks. Therefore, you should choose a fund type that suits your risk performance and investment objectives. Understanding the risk management level of different fund managers. Different fund managers have different management styles, experiences, abilities, and performances, and therefore, they also have different levels of risk management. For example, some fund managers might adopt more aggressive or proactive investment strategies, seeking higher returns but might also face higher risks. While some fund managers might use more stable or conservative investment strategies, aiming for a lower volatility but might also miss some opportunities. Therefore, you should choose a fund manager that suits your level of trust and expectations. Understanding the changes in risk in different market environments. The market environment is one of the most important factors affecting the returns and risks of mutual fund investments. In different market environments, mutual funds might face varying degrees and types of risks. For example, in a bull market, mutual fund might benefit from the market's upward trend but might also face the risk of market bubbles or crashes. While in bear market, mutual funds might suffer from the market's downward trend but might also catch opportunities from market's rebounds or turnarounds. This concludes our current series on mutual fund investments. We sincerely hope that the insights and strategies we have shared have been valuable and will assist you in navigating your investment journey with greater ease and confidence. Please look forward to our upcoming advanced courses on fund investments where we will delve even deeper into this fascinating world. We're excited to continue this journey with you and welcome your continued engagement and participation.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.